Chat with Traders, episode 99.
This is your key to the minds of trading's elite performers, those who profit in relentless markets. Here on the Chat with Traders podcast, you'll hear about the skill sets and tactics that lead winning traders to win, so you can level up and become a better trader. Here's your host, Aaron Fifield.
Sponsoring and supporting this week's episode is TradeStation. TradeStation is a well-established online broker who have been serving traders globally since 1982. In addition to a vast product offering, great commissions, and awesome support, TradeStation are renowned for their remarkable trading platform and technology, designed to give active traders an advantage in competitive markets. So to learn more, please visit tradestation.com and discover why traders trade with TradeStation. What's up, team? I hope you're doing just fine. My guest for this episode is Brynne Kelly. Brynne is an electricity, natural gas, and crude oil trader who has spent the majority of her career on merchant trading desks for the likes of BP, amongst others. She has also been a prop trader and has experience as a hedge fund portfolio manager also. A few of the key topics we hit on during this episode include Brynne's responsibility as head of trading desks, how she taught, trained, and managed newer traders, and an overview for how Brynne trades relationships using fundamentals and macro trends, and plenty more. For many listening, much of this may not necessarily be directly applicable to your own trading, but you will get some great insight to how things work from the merchant side of things. I really hope you dig it. Please welcome an awesome guest for episode 99, Brynne Kelly. Let's just get started. So probably the first question I'd like to ask you, Brynne, is, before trading came along, what were you doing?
So good question. I obviously, or maybe people don't know, so it's not that obvious. I did not start or enter begin my career in trading. I wish I had known about it when I first graduated from college with my little finance degree, but I didn't. My father had been a CPA, and I got my first job working for Cargill right out of college. I grew up in Minnesota, went to the University of Minnesota, and Cargill is Minnesota. So I got my first job right out of college working in, I guess, what you would call today the mid-office for the trading arm of Cargill, which at the time was called the Financial Markets Division. And I was responsible for mark-to-market, P&L, and everything that goes along, with supporting a trading desk for a group that traded baskets of stock on the Nikkei and the Topix exchanges. Very, very manual at the time, but I don't want to date myself too much. And from the moment I saw what that industry was like, I knew that's what I needed to do. And I spent quite a bit of the following years of my career advancement working to position myself in a place where I could get on a trading desk, which I ultimately did, thankfully.
Okay, yeah, and I heard you talking about this briefly on Anthony Crudelli's podcast, Futures Radio. And you said to him that you had to fight really hard to get onto a trading desk. Tell us a bit about that, like how so?
Sure. I guess anybody who's been, a kind of comeuppance in on a trade floor and in the trading world understands that there is not a logical career progression from the mid office or really any other office to the front office. You kind of You either start, in a low rank position, supporting a trading desk in what's called the front office, or, you're on a different career path. So, I recognize that. I saw it, I understood that was the case. So I had to continue to look for opportunities where I felt like I worked for companies that had exposure and had trading desks, and where I could excel enough and get enough relationship with management or with the head traders on the desk so that I could make a move over. And it's not easy. I went through several different companies, and of course, along the way, I'm also advancing my career because I was young, and next thing you know, I'm the controller of Koch Industries in their supply and trading group. Getting a little worried that I was getting too far along in, another career, and, you become kind of untouchable. When you're you're too overqualified or whatever you might be labeled as to, move in to start your career over. But I was persistent, and I continued to make relationships with the trading desks, and really was laser focused. And I ultimately got my break, and it took, I think, about 7 years.
Wow. Okay.
To make that happen.
So when you came onto this trading desk, presumably you had no or little prior experience as an actual trader. How did you learn and get to know what you were doing?
Yeah, interesting. So I think there's a few things in the 90s, early 90s, when I did, kind of get my first role on a trading desk, and it was in the electricity industry, which was just deregulating and just getting started. But it was also prior to really a lot of electronic trading. So the understanding of trading was a lot more logistical and physical. So understanding the physical commodity that you were trading, and I was trading commodities and energy. It was very, very much about understanding the commodity itself and all of the logistics associated with it. So the fact that I had spent so much time in and around the physical commodity helped me out a lot more then than I believe it may help today, just as the landscape has changed to so much financial aspects to the trade itself. So I really was able to transfer a lot of knowledge from that standpoint. And I really just had to learn things like execution, the guts to execute, the guts and the willpower and the stamina to make a decision and take a P&L hit. Those were things I hadn't been directly responsible for prior to that. And those were things I think you either are able to do or you're not. And that really is a big differentiator, between the smartest person in the room and some of the greatest traders is, your ability to actually execute and live with and manage through crisis scenarios, because it's always an immediate crisis once you've put risk on.
And was that something that came somewhat naturally to you, or was it something that did kind of develop over those first couple of years?
For me, it was like I'd come home. I mean, it was so natural to me. I was always competitive, and I loved it. I loved the black and white nature of it. I was so thrilled to be gone from a career where things were based on nebulous items, performance reviews and who you knew or what you did. And it was really right on down to the black and white. And I just felt like that's exactly where I belonged. And I was so happy.
Awesome. So did you get much help from other traders on the trading desk you were a part of?
Yeah, My first, when I got my first break, it was at a merchant power and gas company in the Midwest, US. And since it was startup, it was very much a team that was navigating through this uncharted territory that had not really existed before. So it wasn't like just sit yourself down at a desk and there you go. There was a lot more dependence and team reliance on strategies, trading strategies. When a specific commodity is deregulating, there is a lot of arbitrage that is wide open if you can understand the logistics. And very early on, what our team did was surround itself with very strong logistical people. And we were all coming together and finding these opportunities. So from that standpoint, I was really, really lucky that I wasn't just, trader number 72, here's some capital and have a good time. It was really building a business.
Okay. Yeah, that makes sense. And, during this time, was there anything which was particularly challenging for you?
The landscape did change enormously in the 10 years. In my first 10 years, and it actually has changed enormously in the next 10 or 15 years. And that's always a challenge. The market went from no transparency to some technology and transparency. And, you almost could think about it like you hear people who have worked on the floor of any exchange quote, they'll use, back in the day, and it was one particular way, and you made a living in a particular way based on, the flow of information. And the same thing happened, especially in electricity, but even, in all of the commodities, there was a period of time where if you could make relationships geographically across the US, you could make money. And it seems quickly now evolved into something much different, where contracts were not bilaterally, limited. In the beginning, you only could transact with people via a bilateral contract. So it limited the amount of people who could be even playing, who could show up at the table. It wasn't like you just opened up an account and posted some margin. I mean, you had to negotiate with another firm's credit department and individual bilateral contracts that you were, backing all of your trades with. So there were a lot less players, a lot less transparency, and that was definitely a challenge. Can you move from, going back to the example of the floor, to when it went upstairs, quote unquote, and everything was electronic. It requires really a huge shift change in your skill set, and that was a challenge for sure.
Okay, so when you say bilateral contracts, I'm not really sure what that is. Would you mind explaining that a little more?
Sure. Yeah, that tells me how much they're just, that's how much it's changed. For example, when I worked at BP in the 90s, and, counterparties were Enron and, all of the other kind of trading counterparties that you can think of in natural gas and electricity, you traded directly with each individual company. So there were voice brokers, that are OTC brokers, that would call, and you would have a squawk box and they would make you markets, but they weren't online. And when you hit a bid or lifted an offer, you were given the counterparty's name that you were done with. So you could transact with people in the market that you had set up a bilateral contract, meaning that we can purchase and sell to your company via our credit rating, via posting some collateral with that other counterparty. So every single credit relationship was individual. And when you were transacting, you were transacting specifically with the counterparty, not with a clearing bank. So it was, looking back now, completely inefficient, right? Because you were having to post collateral with a lot of different people. There was no margining on these contracts. So there was just really a netting of purchasing and sales. And even in the very beginning days of, like, for example, intercontinental exchange, when you hit a bid or lifted an offer, your trade ticket revealed to you who your counterparty was. And it was not a clearing bank. It was a physical utility purchasing, and there was a lot of knowledge in that. There was a lot of knowledge available once you found out what counterparty you were transacting with that just doesn't exist today.
Yeah, I had no idea. So you spoke about working at BP there. I'm really keen to spend a little bit of time on that. So what exactly did you do at BP? Like, what was your role there?
Okay, so just to preface that with, most of my career history in energy trading has been on the merchant side, and BP is an example of that. So BP had a merchant trading group, meaning it was unrelated to their core asset business, but it certainly, enhanced, or you could consider it a diversification of the business that they were in. So for me specifically, I was in their gas and power group, which was in Houston. It wasn't my first merchant group that I'd been involved in, but when I started there, BP had just recently purchased Amoco. And hence that's why the office was in Houston, because Amoco that's where their core business had been. And Amoco was in natural gas. So BP had a merchant trading group called BP Energy Company. And it was primarily electricity and natural gas trading on a speculative nature. So it was not trading any of BP's production. It was, the group didn't own on it, any assets per se. Now they did get involved with moving production that BP had, but it wasn't, it really, other than molecule flow, there wasn't a lot of proprietary information that you had. So it was a speculative group, and I ran the Eastern electricity desk. So over the course of the, 5-7 years that I was there, I built from 2 team members really up into a fully integrated desk that consisted of real-time electricity traders all the way through to term electricity traders. And what we did was try to make money. I set the desk up to look like a virtual power plant. So if you don't actually own a power plant and you're not having to dispatch electricity and deal with real-time flows of electricity and moving power across the US to various grids, if you have a real-time trading desk, which is staffed 24 hours a day, 7 days a week on 2 shifts, you essentially can look like you have a power plant by buying and selling every hour on the hour. So you're basically calling utilities all around the US, purchasing their excess or selling to them if they have a deficit, and then sourcing it speculatively in a way, but it's via your relationships that you have across the country. I mean, you're taking price risk on an hourly basis. All the contracts are firm with liquidated damages. So it's very interesting. So I ran everything from the, real-time hour-to-hour group all the way through to supporting a marketing desk and taking risk out 10 to 20 years. So on the other end of the spectrum, there would be a marketing group that also worked, for this BP Energy group that would go out and meet with utilities or users, long-term users of electricity, and try to do a 10-year deal with them, sell them power for 10 years that was shaped, a specific way that was different than, if you look at a NYMEX contract, right? Like if we'll take natural gas, for example, it's 10,000 MMBTUs. And even more specifically, it's 10,000 MMBTUs per day is generally the delivery at Henry Hub. But marketers will be out meeting with people across the US, and they might find a customer that needs 6,000 in the evenings and 22,000 during the day, but the option not to take any on Sundays. And they come back to the trading desk and they say, I need you to give me a price on this. So of course, as a trader, you have to be out in the market. You have to know what's going on, what basis exists between different locations, and you have to provide a 10-year non-standard price that requires different volume optionality and whatever to this marketer. And if the marketer goes to the customer and the customer, accepts the deal, then as the trader, you now have this deal on your books. And so you end up with an accumulation of non-standard deals that you have to figure out a way to hedge. And when you ultimately go to delivery with them, you have to optimize and figure out how to make money off of it. So it's a pretty diverse role when you're in the merchant side of the business. And the hub products that are listed on the exchanges are really such a small part of it.
Yeah, so I mean, it's safe to say that most of your trading there was done off the exchange, right? Like it was off exchange is what I mean.
I'm trying to think about the right way to put it. I would say that pricing and delivery of deals, once you take them to delivery, was not to or from the exchange. The exchange is certainly used as a price benchmark. So you have to be very familiar with, for example, if I was pricing a deal in the Northeast, with the cost of pipeline capacity in the Northeast and how much risk you're willing to take on that pipeline capacity in a winter month. So there's a lot of pricing of deals that are off exchange, but risk is laid off generally at hub locations. So I don't know if it's exactly that it was so much off exchange. It's just that's only one part of it. Any merchant portfolio does not consist, even a producer of any commodity, they don't get the exchange price. Their wellhead or their generation point of the commodity is nowhere near where the delivery point of the exchange contract is. And so while you might think that natural gas is $3 at the exchange, it's well known that producers up in the Pennsylvania area are getting a third of that because it costs them $2 to get it to the delivery point at the exchange. So everything is relative to the exchange, but it doesn't, change the complexity of the story.
Okay. Yeah. So when you talk about, having to actually make deals with other merchants,
yeah.
How long would that take you to actually put a deal together and close that deal and actually make the transaction? Like, what sort of time frame are we looking at?
So marketing deals can take a long time to get to the pricing of the contract. From the day that a trader gives a price, that price is generally good for a few hours, overnight potentially, in today's markets and in really all markets since, years, you can't leave a price open. It may take 6 months for negotiations to lead to, a price quote, whether that's getting contracts in place, submitting a price once and nothing happening and them calling back. But once a price is given, that price is only good for, generally that day. Because as a trader, I can't give someone a quote and then not know if I have any, if I need to lay off risk or not, because the minute the deal is done, it's, the trader's responsibility to lay that risk off in a way that they think will make the most money for the company, and then continue to manage that risk and optimize it.
Mm-hmm. Okay. So this sort of thing that we're talking about here, I mean, it's quite different from what we've spoken about previously on the podcast. Is this kind of the real reason why futures commodity markets exist? I suppose it's chicken and egg, but for sure it is the, exchange contracts are price indicators, right? And if there was not a liquid, reliable forward price indicator, it would be difficult to do long-term contracts because people would always feel like, they would never pull the trigger because they wouldn't know. They would feel like they had no price information. And it is certainly a reason why a lot of the futures contracts move. It's always based on, sure, there's speculation day to day, but in reality, there are real consumers and real suppliers doing long-term deals in the market. There is an airline purchasing, 2 years worth of fuel supply from a bank, let's just say, and now the bank has to go out and hedge that, right? There is a utility locking in their, gas for their power generation. And so they have to go out into the market then, whoever sold it to them, right? And lay that off. So it's a constant push and pull of, were a whole bunch of supplier deals done in the market or a whole bunch of producer deals done in the market? Because of course they're never going to be done at the same time. But generally who those deals are done with is how you can understand, what will end up showing up in the market. So many of these deals, for a long time and probably even still today, airlines haven't had the best credit and the best balance sheets. And really even producers, small producers, it's not as if they can just go out and sell the exact price on the exchange. They're delivering a product that is interruptible, right? If you're producing natural gas and you're selling it into the market and something happens to your well, you're not going to have that production. And so it's interruptible. When you're selling your product on an interruptible basis, you're not going to get as much for it because the exchange products are firm with liquidated damages.
meaning that if I sell NYMEX natural gas futures and I deliver on that and my supply gets interrupted, whoever I sold it to has the option to go in the market, purchase supply at whatever the prevailing market price is, and bill me for it. And producers are not in that business. So when we talk about producer hedging, what they're doing is selling to an intermediary that's willing to take that risk. So they're going to give them less money for their Cal 2017 product. And then they're going to take what's called the firm or interruptible to interruptible to firm risk. And there can be a lot of different, basis in that. It was one of the fundamentals of the, first 3-4 years of electricity trading that I was involved in, and not just me, but, the industry. You bought electricity generation from a utility on what was called non-firm, and then you sold it into the firm LD, liquidated damages market, which is what all exchange products are, and you take the risk that you'll be able to resupply it and you'll make more overall than you'll lose. But, people don't think of that when they talk about producers hedging. Producers just don't get to go out and sell 100% of their production into the NYMEX firm market. They have to sell either to a bank intermediary that will accept their C-rated credit or BBB minus credit. They'll give them a huge haircut, and they'll also give them a haircut because their product is interruptible. So there's, I find it very interesting just listening to high-level commentary that's done on some of price action on exchange products, because that it's really only relative to people that are not going to delivery or aren't, are willing to take that risk, the firm to non-firm.
Yeah. I mean, this is all very interesting, and much of it is quite new to me. So, no, very interesting. Okay, let's pause and give thanks to our sponsor, TradeStation, who are the broker of choice for thousands of retail and professional traders globally. So one thing I've not brought up previously, which I think TradeStation do deserve credit for, is the amazing job they've done of producing an extensive video library of tutorials. This is really great because new traders can easily get familiar with all the features of TradeStation's award-winning platform and tools, and know how to execute and manage trades when it's game time. Plus, TradeStation also regularly hosts free webinars on subjects ranging from options to coding with easy language to trading techniques, as well as a morning market briefing each day too. But to learn more about why traders trade with TradeStation, please visit tradestation.com. Just to repeat, the link is tradestation.com. Now, this episode is also supported by HelloFresh. HelloFresh is a really great meal kit delivery service. So if you're anything like me and hate taking trips to the grocery store and having to think about what you're going to cook for dinner, HelloFresh makes things pretty damn easy. HelloFresh go out and source the freshest ingredients. They then deliver them straight to your door. So you have exactly what you need to cook a delicious, healthy, and nutritionally balanced meal, following simple step-by-step recipes which are supplied. HelloFresh customers can choose from a range of food boxes that are designed to suit couples and families, and you can choose how many meals you'd like to order each week also. So for $35 off your first week of deliveries, visit HelloFresh.com and enter traders when you subscribe. Again, visit HelloFresh.com and enter traders when you subscribe for $35 off your first week of deliveries. In a number of roles that you've had over the years, I was snooping through your LinkedIn profile before we got on this call, and I noticed that you were hiring and training new employees in several of the roles you've had. Were you training traders specifically?
Yeah, if we're going to talk about the past 20 some years in trading, then yes, it was if I ran the trading desk, I was responsible for the hiring and firing of everyone on my desk. And that could include P&L analysts, so clerks that, entered trades and did, that kind of thing, to, traders that I would bring right onto the desk. So absolutely. I mean, as the head of the desk, you're responsible for, wherever it is that experience level that you brought them in, training them, and it's a hard job. You could be having your own bad day trading, but so could three of your staff, and you have to be able to pick them up and teach them the lesson and get the most out of them, regardless of what's happening in your own book. I mean, it sucks on a day if a trader comes to you and says, "Hey, I'm down $2 million." I mean, that's part of my P&L, right? I mean, I'm the whole desk. So you have to learn the art of teaching somebody to navigate through a crisis, and also determining if it's a fireable offense, although those are generally very clear. Luckily, these days there are things like hard risk limits and volume limits, and whatnot. And I mean, really, you almost hope someone violates something like that, because then it makes it easier if you have to let them go versus if they're just kind of not very good for a while.
Okay. So what were some of the things that you'd teach these people when they first came onto your desk? Let's presume they don't have much experience trading. What were some of the first things you'd really try to drive home?
Well, for junior traders, knowing the systems that support, your the desk. I think for me, and it could be the way that, I came up through my background, you have to know whatever system it is that is supporting the trading business. And by system, generally people refer to them as like an ETRM system, or maybe they call them your P&L system. How are trades getting captured? How are they getting, organized into your book, your strategy? How do you know how, to have clarity if you've had an error in that? Because, I mean, of course, understanding what your position is so that you can trade it is the most important thing. So I personally never tolerated people saying, I don't know. The system says I'm long 100, and, they're not. It's their responsibility to know what's going in and out of the system that is there to tell you how much risk you have. So for me, those were very, very basics at the very beginning. And for me, I didn't tolerate people who threw their hands up about quote unquote the system. Probably doesn't happen today. I don't know. Everybody knows how things flow, but it still seems like people find it a mystery how a corporate ETRM system works, and they have no ability to problem solve. They're like, I don't know. The system says I'm long 50 and I think I'm flat, but no ability to figure out how that error could be there. I mean, could be massively costly errors. So absolutely 100% know your position and know that it's right, because the amount of price movements and the amount of P&L errors you can have if you don't know that. And maybe that seems like a funny thing to people who are maybe, right now trading online with some broker and all of their trades are there. But in a more dynamic scenario where there are trades and positions and they're physical in nature as well, coming in from, a multitude of areas, it's a little more complicated. So number one, I always was a stickler about that. And then two, I guess what I really did was train people to have their opinion and not overmanage when they're wrong. I had teach them things that I look at, indicators that I look at, suggest, market thoughts, but you don't want a clone of yourself. So it's definitely about getting someone else's thoughts out of them and giving them enough confidence in those thoughts. You can't really, there's no manual, there's no, you just learn the commodity and you learn the flow and you learn it by sitting there and you really learn it by, your holy crap moment when you're responsible. So
yeah, I mean, so you spoke about a couple things that almost frustrated you there. How many of the traders came through, were able to do this? Were there traders who just didn't get it? You got frustrated with them and they ended up making some errors and you had to give them the boot. I mean, how many traders kind of made it? How many didn't? What was, I don't know if success rate is the right word, but that's kind of what I'm getting at.
I don't know actually that I've ever looked back at it and given it a percentage number. I have fired my share of people who weren't cutting it. And in it, I've also moved people to roles that maybe were more suitable to them. There a lot of times the way a trading desk can be structured is the hierarchy seems to go from scheduling or ticket entry or, very, more manual type of data collection roles to shorter term trading to longer term trading. And so many kids starting on the desk sort of thought as soon as they were, a long-term trader, then they were, that was the right progression. And I can't tell you how many times, there'd be some young trader who was responsible for just trading, 1 month in, right? They had a short-term duration who believed that the longer term duration was, where it was at. And, I'd give them a chance and you'd find out that that wasn't the case. And so a lot of times it was just educating and moving them back into the shorter term role. I always felt and tried really hard to make it known that as long as you're making money, it really doesn't matter which part of the curve you're trading. So don't try, to be at a different part of the curve. I mean, a bottom line is a bottom line, but that did happen a lot where people tried to come, they wanted to come to the next table and didn't have the skill and they were either fired, or demoted.
That's really interesting. So why do you think it was that the shorter term traders wanted to become longer term traders? That seems really unusual.
I think there is a majority of structures that can exist at companies where the longer term traders have exposure to more capital, have access to more capital. I mean, it just takes more capital to commit a 10-year deal than it does to commit a 1-month deal. And so the stakes can be higher as far as, your P&L targets. And so the money, the payouts can be higher. However, those are the people that also get fired more often too. I mean, you have to understand that, the higher your P&L targets are, the first one you are out the door. But there are so many structures that exist in the industry where the term traders get paid more. So because they have access to more capital, but it's not always the case. And I think, it was my responsibility to to guide and to make sure that somebody who was just trading next day or next hour power had this, same drive and understanding, and access and the ability to deliver to the bottom line. There are some schedule things that are crappy about the shorter term duration you have as well. So, if you're working on a real-time electricity desk, you're on 12-hour shift work. So, of course, you'd want to get off of that, right? And move up to a day job versus working, 6 p.m. to 6 a.m., 4 days in a row, then off 3. There are some schedule things as in any, sort of career advancement, right? Whereas you move up the ladder, there maybe is some more flexibility. And the assumption is there's more money, but I would argue there isn't always.
Okay. And why do you think it was that some of the shorter term traders found it difficult to transition to more longer term trading?
The knowledge isn't necessarily transferable on the fundamentals that make sense in the shorter term versus the fundamentals that make sense in the longer term. They're very different. And if you want to get really granular, you could talk about if you were thinking about electricity or even like cash natural gas, right? Next day natural gas. The fundamentals of the pipeline relationships and the capacity available and weather is very different than the fundamentals that would drive a Cal 2018 trade. You could look at interest rates in 2018. You could be concerned with LNG. There's a different. It's just a different set of market influences, and I think that can catch a lot of people making that move. They've got their arms and they really are good at the fundamentals that drive the short term market, and it's just not the same.
Yeah, no, that really makes sense. Actually, that's a good answer. So, bringing us forward to current times now, what's your current situation and what type of trader are you today?
So, having spent almost all of my energy trading career in merchant roles, I definitely am a much more fundamental trader, in that I care and I pay attention to, and I guess the way I trade revolves around relationships of one thing to another, because that's how my whole experience evolved, whether it was the relationship of power at point A to point B, or it's all the way, evolved to a frac spread, right? Or a heat rate between electricity and natural gas, or, LNG, or, gas in one point or another, or, as ethane factors into the picture. I really, my approach is that I like the bigger picture. And I'm always interested in how relationships are changing. And I'll even call algorithmic relationships part of that. So that's how I look at the market. I have done a couple stints at prop shops. I don't know if it's just because that was not how I came up. I don't find specifically an exact technical charting, exact reversal entry point, scalping type of thing to be how I approach the market. But there's a lot there. There's absolutely a lot there. I kind of wish I maybe had a little bit more of that, but I can't force something that's not there. And I focus more on relationships and structure when I look at the market.
Okay, cool. Well, let's talk about that a little bit more. But just before we do, like, what's your current situation? You said you've done a few stints at like prop firms and that sort of thing. And I know you recently were managing a fund at Millennium Partners. Have you since moved on from there?
Yeah, not by desire, but it's what you sign up for when you sign up to be a trader. I was until last year, I was was portfolio manager at Millennium Partners, which is a hedge fund in New York City, and they had started up or allocated funds towards commodity only trading. Not that they weren't involved in commodity trading, but it was more embedded within equity groups. And I was their first electricity trader. And I would just, I guess, say that at the end of the day, it wasn't for them. Their systems that weren't geared for it. Their understanding of the market wasn't deep enough, at all. And not anything. I mean, they're a class organization that, was trying new things, and it wasn't, I would say that they weren't probably quite ready for it, and good for them for knowing that they weren't, that they're just, it's one thing to have a corporate system to handle equities and debt. It's another thing to have a system that can track the hourly flows of power, and it's very complicated. And I've even written prior to one of my prior roles. I went to work for a software company as a subject matter expert and designed from scratch an entire ETRM system just for power, because it is that complicated to model and handle. So they gave it a shot for a year, and the black and white world, they said not for us. So I'm back to as most, I think, traders who can't, it's in my DNA, working on, sort of managing some family money and doing some of my own trading and working on a bunch of different startup ventures and anything, related really to what's happening today, especially in the deregulation of electricity. I think it's fascinating what's going on. And it's hard to even pick somewhere to focus. It's fascinating.
No, that's excellent. Very good. So going into sort of your trading methods and the way you approach things, you said that there wasn't, I can't remember exactly the wording you used, but you said like you don't see an exact entry point on a chart and that sort of thing. So how do you turn these observations and these relationships of macro trends, how do you actually turn them into actionable trade ideas? Like, how do you go from having an idea and seeing something, anticipating something, and then actually executing that?
Tough question. So, like I said, I am a student of relationships, and I respect, areas on a chart or sentiment and all of that stuff, but it's not like, yeah, you're right. It's not how I use to get in or get out. I find a few things can tell the story pretty easily, and that is time spreads. So calendar spreads along the curve. And I, just like, not you can be right or wrong, but for me, you could take an example of the situation this summer in the United States with natural gas and the structure of the price curve, and how do you translate that into something actionable? And all summer we saw the daily cash prices exceeding really the balance of the month or the next, the prompt futures contract. And to me, that is actionable because that tells me what will happen with storage operators, and luckily it played out, right? If you own storage, and you could either buy some natural gas in the market today that costs more than natural gas for delivery in the next futures month, you're just going to wait. And of course, this is a simplified. I mean, people will call, people have to ratably inject into storage. I understand that, but there is a global macro kind of step back, effect that the price curve can have on what ultimately plays out in the market. And so for me, they're very obvious. And the actual price, I don't care if the cash market is 5 cents over and we're talking about $10 and $10.05. I don't really care what the actual price of it is, even though people want to focus on that and ask about and talk about all the time. What's a good price? Do you think $3.50? Do you think natural gas will go here? Do you think crude oil will go here? I mean, I don't actually care. I care that the spread levels tell you what the next move is going to be. And so I certainly like either trends of relationships and spreads or outliers, especially if there are certain parts that I think will mean revert. So a lot of calendar spreads can, get pretty far from the mean. Doesn't mean that, it can't go another 3 standard deviation outside of it. So, but if you believe that something will mean revert, then you're never going to pick the exact point to get into it. But, put enough on it then that you can, stand to wait until that mean reversion happens. I don't know if that was specific enough.
Yeah, no, I think that gives us a pretty good overview of how you're approaching things. By nature, you're a longer term trader. When we talk about longer term, like what are we referring to? Like what's your average holding time for a given position?
It's gotten shorter, that's for sure, because the markets are really different now. And no matter where it is in the term structure, I would say probably not more than 3 months, because you're just not going to have enough. I mean, by then, either the spread you have on is going to delivery. It's gotten a lot shorter, and some of the moves have gotten a lot more violent, definitely.
So why do you think that is? Why do you think, like you said, the moves have become more violent? And what are some of the other really big changes that you've seen yourself, having been done this for now over 20 years?
Well, I mean, of course, this is just my opinion, but I think there is a whole generation of, number one, trading itself is more accessible. So the pool of players, market participants, is just so much bigger than it was even 10 years ago. And, beyond that. And we could go back to my discussion about, bilateral contracts. This central clearing of all contracts is not that old. It's relatively, a newer phenomenon. And, and Dodd-Frank kind of helped that along as well. So the pool of market participants is so much bigger. And the transparency, the market transparency is also, it's more transparent. There's just everybody and their brother can see what prices are. They don't have to wait for the newspaper to be printed or not have, access to something online. So there's a lot more participants. There's a lot more participants with shorter durations. And so, they can get pushed in and out quicker. With less capital that they're applying towards their trades, and I mean high frequency trading, or I don't even know what you call it, but I'll call it algorithmic trading. It's really where it's at. And I'm not saying that for me personally, but if you could imagine when there were market makers on the floor of an exchange before we went to the decimal system. And so the bid, it was like a half by a quarter, and the spread between, being a market maker was so great and lucrative that's all you had to do. That exists today for algorithms, and it is being exploited until it's not there anymore. And what I mean by that is relationships that exist between when people start buying soybeans and then how that ultimately flows through to ethanol, or, I'm not even using that far reaching of an example, but it's all the psychology of all of that and the ability to execute those relationships faster and faster and faster is what's happening now. So it's an amazing moneymaker for those who are buying tick data and developing relationships and running, machines. And I don't mean big, huge ones that are pushing it around, but, you add a psychology component into it. And, we've just taken the fraction system on the floor before decimals to a new level. And that's where I think it's coming from. I'm not saying, I'm not making a judgment at all, but I think, you can't be naive and not understand, which, really kind of goes back to what I like best is understanding relationships. It's just that people are doing it using computers at, levels that are beyond me.
Yeah. And do you think this has made it somewhat more difficult to be a fundamentally driven trader?
It's made it more difficult to be a fundamental trader if you don't have enough capital.
And what do you mean by that?
There are a lot of scenarios in which the fundamentals will ultimately win out, I suppose. Is that the right word to use? But a lot that can happen until that does. And if you don't have enough capital or enough VAR, and you're constantly getting chopped and stopped out until your fundamental play happens. We can, let's say the deviations from the mean have gotten bigger. And so if you have a $10 million VAR and you can ride, that $50 million P&L swing, or you can ride that until you come back and make, your money instead of having to stop out and then try to get in. Then you're just chopping up your capital the whole way. So the tolerance to, take those hits. And I don't think there's as many players as there used to be that can do that. Or it's very concentrated. It's very, very concentrated. And even hedge fund structures aren't as much like they were in that they silo out allocations of funds so that any one group may not have, as a whole, it's a lot of money, but individually, risk limits, they keep being parsed down further and further. And so, a simple thing as a front month spread, like, December, January, so many players have to get out of that spread before even the last day in futures because of, T+1, margining limits and whatnot. And, if you don't have enough capital to post it, or you can't risk making or taking physical delivery, the amount of players that can actually take advantage of the real fundamental story playing out is smaller. So there's just noise on the intraday.
Yeah, now this is a question that I'm pretty interested to hear your response to. And I'm not quite sure what the best way to perhaps frame it is, but, you've spent your entire career pretty much focusing on this sector. How will would you say you can actually read the market? Like, are you often surprised by certain things that happen which are opposite of what you'd anticipated, or does something like that really happen now?
I can say that I'm not surprised, but I wouldn't want anyone to mistake that for that I get it right. I could tell you, I was more surprised in, I guess, was it the end of 2014 when crude was trading $80, $90, and the fundamental nonsense and stories and whatnot that went on when, for sure, there was no other path other than $30. The calendar spreads told you that, everything did. And yet, so what can surprise me still is the interpretation, the story, the blinders, that the signals that people are unwilling to pay attention to. That can surprise me. Or now after a year and a half, 2 years of markets cratering, in energy, everybody still wants to be on the story of full storage. It's like, move on. But full storage after 2 years is not the same story, right? As after people have had to try to cut and do this and that. So I guess it does. Yeah. I guess what continues to amaze me is interpretation of the story from the market. But I'm certainly not saying that in a way that I'm, that means I get it right. It's just, the fundamental story can be pretty obvious, but you can't trade fundamentally alone either. That you'd get killed.
Of course. Yeah, no, I think that's a good response. So, Brynne, I'd just like to ask you a couple more, I guess, sort of more general questions, which might be really helpful for anyone who's listening to this podcast. Anyone who might be an independent trader who is sort of just coming into things. Like, what would you say to someone who is entering this business of trading? What would you say to them to ensure that they have realistic expectations?
Okay, good one. So, and I heard you say independent. So at some levels, are you talking about someone who might be just
trading from home? Let's say that.
Trading on their own. Okay. So I've said this before and I'll say it again. You have to decide if you're trading, from on your own, if it's your hobby or your actual business. Because a lot of people have a hobby of, restoring cars or, whatever it might be, but there is no chance they could ever make a living at it because it would take marketing and buying, setting up a shingle and advertising and blah, blah, blah. You get the gist, right? So, do not for 1 minute, misinterpret, you decide, is it a hobby or if it's an actual business, and you need to check yourself all the time if you're deciding that it's a business. And, not everybody makes it in a startup business. All across the world, people try to start up a business and they don't make it. If once you do that, you can't just, that's not the right word. I would recommend don't spend your whole time, especially if it's your kind of first career, just trading on your own. You got to step in and out of things and experiences throughout it. So go work for some place for a while, and then maybe do it on your own. You will not believe the different perspectives that you'll get and how much it will evolve over the years. It will blow your mind, what you think you know and what you can learn. And I would never limit myself to just, trying to master a skill, on your sitting alone and banging it out. It's no fun, and it's not going to lead to a very well-rounded person. Go do other jobs within the trading world, whatever that looks like, right? Work at a broker desk for a while, go, be an analyst for a bank, in and out. If you do a full-time, you do a part-time, you got to have more, you got to continue to get other experience or push yourself, take classes, but don't assume that it's as one-dimensional as you think it is, whatever that dimension is, because it never is. It's never that one-dimensional.
So that's really something you do strongly encourage, is that, someone does try to get some sort of job related to trading.
Well, and maybe I'm old school when I say job. I mean, maybe it is that you can get that perspective and knowledge other ways, right? Through social media or something. I mean, maybe I'm just too old school, but, don't just align yourself with people doing the exact same thing that you are.
Yeah, sure.
I mean, certainly you want that, but, push the dimensions hard.
Yeah, no, that's good. That's good. And when you say you've got to decide whether you want trading to be a hobby or a business, for anyone who might not quite understand what you're saying there, how would you differentiate those two things?
So trading hobby is, you're not focusing as much attention on it as you would a full-time job. I like seeing people say, oh, I'm trading, and so I can go out on my sailboat or go do this in the afternoon or do that. I don't know any other startup business owners that do that. I don't know someone that started up a restaurant or opened up, some app whatever the startup Silicon Valley things are. I mean, I don't know anybody that's like, brags that they can do it for 2 hours in the morning and then move on. A business is a business, and you are, devoting your endeavors to that 60 hours a week, 70 hours a week, and you're not putting bad trades off a side, in another account. I mean, you have to hold yourself accountable, and you have to be constantly expanding your business. So that in no way, shape, or form do I like comparison. If it's a business, it's a business, and everybody knows what a business means.
Yeah, I really like how you talk about this as a business. Like, a lot of people say you got to treat trading like a business, but you're really sort of saying that trading is a business. You know what I mean? Like, even if you are an independent trader, you need to treat it as though you're actually, here you are, you're starting a new business, and you've got to run it like a business. So
you got to run it. That's right. Absolutely. And you business plan, sales techniques, they all apply. They all apply. Not that you're selling things so that, some other, but maybe you should be. Maybe you should be also thinking about honing a talent that you could turn into something sellable based on your information, that you're getting in trading. I mean, it's just not swatting the market around on the screen a few hours a day and then going, but I'm sure people are going to laugh at that and say, oh, that's what I do. It's so great. I mean, I just wouldn't say that that's a majority of people.
And what if it's not feasible for someone to put in, like you said there, 60 hours a week into their trading business because, they're just not that profitable as a trader to be able to, that they need to have some income to, support their day-to-day living.
Yep.
What tips or pointers would you have for someone in that position just to make things a bit more feasible?
Well, I mean, if we're going back to the hobby scenario, right? I mean, you may like to refurbish cars in your spare time, but you can't quit your full-time job for that, right? But you can still refurbish cars. I think, if you want to allocate money towards something that you enjoy, which is, looking at investments, that's a good hobby. If you want to progress towards a career as a trader, then apply for a job involved somehow. So because if that's the thing you need, right, an income, then go be, please, I'm just using examples. I don't mean these, but right, like a clerk on a desk or an analyst or intern for something, and join an investors club, something, right? I mean, if that's what you're trying to progress to, then work your way into it, just as you would try to work your way into it from any hobby that you had, that you were trying to turn into something you wanted to make a living off of. I just, take a serious road towards it, right? I mean, anybody could imagine what they might do if in any other business they were trying to leave their current job to move towards full time. And there's a lot of preparation that goes into that.
Well, Brynne, let's leave it at that. I just want to say big thanks for doing this. I mean, I've really enjoyed it. This has been very good. So where's the best place listeners can go to find out more about you?
Well, I'm on Twitter. I think that's where a lot of people find me, at Brynne and Rick, BRYNNE ANDRIC. Or that's a great place to find me. You can check out my LinkedIn, but yeah, I'm on Twitter. At the moment, the only time in my career where I have been able to use Twitter, when I've never been allowed based on corporate employment to actually speak via Twitter, and I'm just taking full advantage of it and trying to get my market my market research style out there.
That's very good. So at Brynne and Rick is your Twitter handle. Anyone listening, go follow Brynne on Twitter. And Brynne, I just want to say I really appreciate you taking the time to do this. Thank you very much.
Yeah, I enjoyed it. Thanks a lot.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.